Hello and welcome to another Can Indian channel feature. In today's video, we're going to be looking at bond valuation. First, let's understand what are bonds. To be clear, this has no correlation to the James Bond 007. On a hindsight, that may be really cool. Diving straight onto the topic, businesses take on debt to finance the operation. When corporation borrows money to finance its operation, it can choose to either take out a loan from financial institution, such as a bank or insurance company, or issue or sell bonds. When debt incurred through a loan from financial institution, it is often referred to as private debt, because the debt is not publicly traded. In contrast, bonds are referred to as public debts because they can be traded in the public financial markets. The main difference between a bond and a stock is bonds have maturity dates and usually low risk compared to stocks. Let's understand with an example. If you watch my other videos on MBA 101 Finance, I use an example from my previous business called iHappy Novelties. The business was mainly selling t-shirts. iHappy Novelties was listed as a corporation and we wanted to expand and open more stores. So we had two options, either to go to a bank and get a loan or sell bonds at a yearly fixed interest to investors. So say I issue a $1,000 bond to an investor with a rate usually called as coupon rate of 5% with a maturity of 5 years. So each year iHappy Novelty will pay the 5% coupon rate, and at the end of the 5th year, the investor returns the bond to iHappy and takes the $1,000 principal back. What did we learn from this in terms of corporation owners? We got the money we needed for expansion. We paid yearly interest, and the end of the 5th year, we no longer need to pay the coupon rate or the interest, and we are free of debt. As an investor, they get regular scheduled payments. They get return of the invested principal at the end of the maturity. They could now reinvest the money plus the accrued interest or use them to fund their own separate interest. The stark difference between a stock and a bond are that in terms of stocks, the profits and losses are driven by market forces, and for the sake of these videos are generally less predictable, whereas bonds are completely opposite. Well, there's always risk with loans, and the risk with bonds are that the issuer will default on paying the principal. Remember the video about risk-return trade-off? If not, please watch that video where I explain how usually lucrative interests may have higher risk associated with it. Mainly government issue bonds, which usually pay lower coupon rates as they are considered stable. Corporate bonds, however, typically represent a greater risk, hence have a higher coupon rate as companies may go bankrupt. Several credit agencies assign ranking to different bonds that may help the investor determine the risk reward. We're going to look at a mind map that a teacher from Pakistan helped me create, and I decided to include that in my video. Please feel to reach out to me or visit my website to download the video or this mind map. It's all free and was made to help students such as yourself. Let's look at some key features of the bond. Using the example we reviewed, the bond indenture, which is a legal agreement between the firm issuing the bond and the bond trustee. We then discussed on how to structure the coupon rate depending on income and assets. Most importantly, the face value, which is a principal that needs to be repaid at maturity. We discussed that the coupon rate, and most importantly, which I did not touch upon, was the current yield, which is the rate of return the bondholder will receive if he purchases the bond as its current price and holds it until maturity. Meaning it is the projection which the investor or the bondholder forecasts by investing in the bonds than by just saving it in the bank accruing interest. Remember, the bank interest rate fluctuates. When bank interest rate is high, it's best to invest in bank savings. If the bond interests are high, it's best to invest in bonds. Usually, at least in the US, the bank interest rate is inversely proportional to bond interest rate. Meaning if one goes up, the other goes down. I'm not going to detail about this scenario and may explain this in another video. Next, I want to touch upon an interesting concept called call provision. A call provision is a stipulation on the contract for a bond that allows the issuer to repurchase and retire the debt security. call provision trigger events including the underlying asset reaching a present price and a specified anniversary or other date being reached. The bond legal contract will detail the events that can trigger the calling of the investment. In simple terms, back to my example, if my corporation of iHappy Novelties decided to issue bonds of $1,000 at 5% coupon rate and have a stipulation in the contract of call provision after I reach certain investment for expansion, then I could pay the investors or the bond purchaser the accrued interest and principal, say after 3 years, instead of waiting for the whole 5 years. Note, it's important for the bond purchaser to look into what the call provision terms are stated by the issuer. Lastly, let's look at the conversion feature. As the name implies, a convertible bond gives the holder the option to convert or exchange it for a predetermined number of shares in the issuing company. When issued, they act just like regular corporate bonds, albeit with a slightly lower interest rate. Because convertibles can be changed into stock and thus benefit from a rise in the price of the underlying stock, companies offer lower yields on convertibles. If the stock performs poorly, there is no conversion and an investor is stuck with the bond subpar return. Remember, as always, there's always a trade-off between risk and return. Now let's look at why do companies issue convertible bonds. Companies issue convertible bonds or debentures for two main reasons. The first is to lower the coupon rate on debt. Investors would generally accept a lower coupon rate on a convertible bond, compared with a coupon rate on an otherwise identical regular bond because of its conversion feature. This enables the issuer to save on interest rate, which can be substantial in a case of a large bond issue. So in my case of iHappy Novelties, I would issue convertible bonds to the investor to be converted to company stocks. Remember my previous example when I explained how stocks are determined by market trends. So if people are going to go crazy and the t-shirt were high in fashion, making sales for the iHappy to rise, which means the stock would yield a better return for the investors. Contractually, the corporation will always state the conversion ratio for convertible bonds. For example, with iHappy, my corporation will set a conversion ratio of 10:1, meaning 10 bonds can be converted to purchase of one stock of iHappy. Next, we're going to look at the effect of inflation rate on interest rate. Owning a bond is essentially like possessing a stream of future cash payments. Those cash payments are usually made in form of periodic interest payments and the return of principal when the bond matures. In absence of credit risk, the risk of default, the value of that stream of future cash payment is simply a function of your required return based on your inflation expectation. If that sounds a little confusing and technical, don't worry. I'll make a video on breaking down bond pricing, defining the term bond yield, and demonstrate how inflation, expectation, and interest rate determine the value of a bond. I really hope you enjoyed this video, and special thank you to that teacher from Pakistan to contribute to this channel. The video from this channel are now reaching unprecedented number of students across the world and has also been picked up by universities in the US, South Africa, Ireland, and New Zealand. I keep my videos concise, succinct, and raw, and you may have noticed some spelling mistakes in the slide. Please feel free to comment if you have any more questions. This is Can Indian Channel signing off. Peace.